One of the most common economic claims is that billionaires pay less taxes than working class Americans. How do they do that? Are they cheating? Most of the time it is legal. They simply take advantage of the tax code as it was written. The biggest difference between the wealthy and everyone else isn't income, it's how their money is structured. What they do is control when, how, and if income shows up on their tax return. And that control is everything. Hi, I'm Sue Cunningham, the Wealth Protection Lady. I help people nationwide grow and protect their retirement savings from market losses using insurance-based strategies such as Index Universal Life and Index Annuities. The wealthy organize their money into three buckets: taxable, tax-deferred, and tax-free. Most people only use one or two. Bucket number one, taxable. This includes wages and salaries, distributions from retirement accounts, interest, dividends, and capital gains, stocks, bonds, and mutual funds, and other investment income. Bucket number two, tax deferred. This is where most Americans live. This is your retirement account and your IRA. You get a tax deduction today, but every dollar coming out in the future is taxable. And you don't control the tax rate, the IRS does. Bucket number three, tax-free. This is where wealthy people spend the most time. This bucket includes your Roth IRA, Roth annuity, and Index Universal Life Insurance, or IUL. The goal here is tax control, not tax avoidance. This is where you can access money without triggering taxable income. A properly structured IUL can function as a powerful tax-free accumulation and income tool. With an IUL, your cash value is linked to a market index, like the S&P 500. Your money is not in the stock market, but it grows based on the performance of an index. So you get market-like returns, no stock market risk due to a 0% floor. So if the market has a negative return or crashes, you can never lose your principal or interest earned. Remember Warren Buffett's golden rules of investing. Rule number one, never lose money. Rule number two, never forget rule number one. This risk control is the number one reason high net worth individuals purchase IULs. You have tax-free access to your money. No required minimum distributions. No 59.5 rule. No contribution limits. No age restrictions, and minimal fees if structured properly. So in retirement, instead of being forced to take RMDs, you choose when or even if you create taxable income. That flexibility is incredibly powerful. A properly structured IUL can be the most powerful tool in bucket number three. Here's something most people don't realize. Taxable income in retirement can increase your Medicare premiums, cause your Social Security income to be taxed, trigger capital gains taxes, and reduce credits and deductions. So wealthy people don't create taxable income unless they choose to. This is what paying zero taxes looks like. You require a tax-free retirement income of $100,000 annually. So you take $40,000 from Social Security, which is not taxed, $30,000 from your IUL, which is also not taxed, and $30,000 from your 401k, which is taxed. If you are married filing jointly, you pay zero taxes on the $30,000 401k distribution because your total taxable income is lower than the standard deduction of $31,200. It's that simple. That is legal. That is IRS approved, and that has been in the tax code for over 100 years. If you want to understand whether this strategy makes sense for you, please click on the link in the description below and schedule a free consultation with me. If you found this helpful, please like, subscribe, and share, because more Americans deserve to know how to pay less in taxes.